Welcome to Voyage Daily Tech, the most important news personalized for you every day, supported by Voyage.com.
After listening to today's news, you'll know. First, FBI Most Wanted hacker reveals ransomware gang's friendly ties to Russian intelligence, detailing a dark franchise model. Today, we'll take a closer look at the industrialization of hacking and its implications for global cybersecurity and law enforcement's ability to attribute attacks. Second, 80% of India's data centers face high water stress this decade, threatening the global AI build-out led by Google and Meta. We'll explore how this resource crisis could transform data center design and impact the global race for AI infrastructure dominance. Third, $7.8 billion US investment surge in Africa overtakes China, sparking a new rivalry for critical minerals essential for AI and semiconductors. We'll analyze why this is a turning point in the US-China tech rivalry and how it could reshape the entire global hardware supply chain. Fourth, 33 billion euros in Japanese slow money floods European deep tech and AI startups, bypassing Silicon Valley for a new strategic alliance. In this episode, we'll break down this new IP for industrial scale model and what it signals for the EU-Japan bid for strategic autonomy. Fifth, State Street doubles down on the AI trade despite Nasdaq's worst week, challenging investors not to flinch amid rising volatility. So we'll discuss why this market standoff matters and what it means for investors navigating the AI productivity paradox and geopolitical risks. When asked if ransomware gangs work with Russian security services, a Cyber-Kingpin speaking from a US prison gave a chillingly simple answer. Of course. But the reality on the ground is far more complex than simple state sponsorship. Penchikov operated out of Ukraine, and after the 2014 conflict with Russia began, the entire region became a chaotic breeding ground for cybercrime. Research from the UN shows that as traditional smuggling routes were disrupted, criminal networks pivoted to the digital world. This created a murky ecosystem where nationalism, corruption, and profit all blur together, making it incredibly difficult to draw a clean line between independent criminals and state-backed actors. For the first time ever, Vyacheslav Penchikov, known in the underworld as Tank, is talking. Once a leader of two notorious hacking gangs and on the FBI's most wanted list for nearly a decade, he's revealing the inner workings of a global criminal enterprise. This isn't a story about a tech wizard in a basement. Penchikov describes himself as a friendly guy who climbed to the top with criminal charm. In his early 20s, he says cybercrime was easy money, and he bought new luxury cars like they were new clothes, including an Audi with a 500 horsepower Lamborghini engine he once used to outrun the police. But the story gets darker. Penchikov's journey charts the evolution of cybercrime, moving from simple bank theft to the devastating world of ransomware, where his profits soared to $200,000 a month. This is where the situation takes a more complex turn. He was part of a major shift in the underworld, the industrialization of hacking. Early on, it was about direct theft, but then came ransomware as a service, or RAS. Think of it like a dark franchise model. A core group develops the malicious software and then leases it out to affiliates who launch the attacks. Leaked files from the infamous Conti ransomware group, for example, revealed they operated like a legitimate tech company with an HR department, salaried employees, and even performance reviews. This model lowered the barrier to entry, allowing more criminals to launch sophisticated attacks and share in the massive profits. He reveals the cold logic of the hacking world, describing a herd mentality. He recalls a rumor that a hospital paid a $20 million ransom, which immediately caused hundreds of hackers to start targeting medical institutions across the US. As he put it, people don't care about the medical side of things, all they see is 20 million being paid. This herd mentality is a core part of the social dynamics in these elite anonymous groups. Trust is everything, but it's built on fragile online reputations and peer reviews. When a rumor of a huge payout spreads through their private forums, it's not just about greed, it's a signal to the entire community about where the next big score is. It reinforces a member's status to be seen chasing the same targets as other top-tier hackers. One of his gang's attacks on the University of Vermont Medical Center crippled 5,000 computers and cost the hospital over $30 million. And it shatters the myth of a victimless crime. While hackers like Penchikov might believe their targets can afford the loss, the reality is devastating. Even when courts order massive restitution payments, the Department of Justice confirms it's incredibly difficult to actually collect that money, especially from incarcerated individuals. The victims, like that hospital, are often left to foot the bill themselves, which can impact patient care and community services for years. Now serving 2 9-year sentences, Penchikov's only real regret isn't the victims. It's that he got too trusting. His final lesson from a life of crime: you can't make friends in cybercrime because the next day your friends will be arrested and they will become an informant. In a world where your identity is hidden, the only thing you have is your reputation. But the constant threat of law enforcement infiltration means that the person you trust today could be the FBI informant who takes you down tomorrow. It's a social structure built on a foundation of deep-seated suspicion. Meanwhile, his former partner, Maxim Yakubets, remains at large, with the FBI offering a $5 million bounty for his capture. This is a perfect illustration of the safe haven problem. Penchikov was only caught when he travelled to a neutral country, Switzerland. His partner, Yakubets, is likely in a country like Russia, which typically does not extradite its own citizens for crimes committed abroad. This forces agencies like the FBI into a global cat-and-mouse game, waiting for these wanted criminals to make one wrong move and cross into a country where an arrest is possible. We just heard about the dark side of the digital world, but now let's turn to the very physical and increasingly strained foundations that world is built on. A new study just dropped a bombshell. Up to 80% of India's data centers are projected to face high water stress within this decade. We previously analysed how the AI build-out is turning into a global resource race. And the latest development is that in India, the scarce resource isn't just power, it's water. You know, data centers are basically warehouses packed with powerful computers that run everything from our social media feeds to complex AI. These servers generate an incredible amount of heat, and to stop them from melting down, they traditionally rely on massive cooling systems that use water, evaporating it into the atmosphere to carry the heat away. We're talking about a scale that can use millions of litres of water a day. As we've said before, these are the AI factories of the digital economy, and they chew through not only electricity, but also a lot of water. This is happening as tech giants like Google, Meta, and Amazon are in the middle of an investment frenzy, pumping billions of dollars into the country. Google alone just made a $15 billion bet on a new AI data center there. A while back, we broke down how Meta, Amazon, Alphabet, and Microsoft are planning to spend over $300 billion on AI next year. What you're seeing in India is that capital expenditure landing on the ground. And this frenzy is just getting started. The research shows India's data center capacity is on track to nearly double by 2026 alone. This has sparked a really intense debate. We're seeing India get a massive economic boost, while at the same time, it raises the question of whether the country is becoming a resource colony for global tech, where its precious water and power are consumed to fuel foreign AI ambitions. A few days ago, we mentioned how countries from the EU to the UAE and even Saudi Arabia are vying to host these AI factories under sovereign AI strategies. Today, the focus shifts to whether India's bid to win this race risks trading strategic upside for deepening resource stress. Why the gold rush? India accounts for 20% of global data generation, but has only 3% of the world's data centers. It's set to consume the most data on the planet by 2028, and building costs are some of the lowest in the world. But those low costs aren't just about cheaper land or labour. There's another less discussed factor at play, what's called regulatory arbitrage. That's a fancy term for companies potentially building in places with less strict environmental oversight. Data centers in Europe or even parts of the US face intense scrutiny over their water usage. Google, for example, drew huge criticism in Oregon when it was revealed its data centers were using over a quarter of the entire city's water supply. A lax regulatory environment can be a major, if unspoken, financial incentive. Continuing our last discussion on different models private sector led in the US versus more state-driven oversight in sovereign A. Playbook's regulatory arbitrage is part of how siting decisions get made. This explosive growth is on a collision course with a terrifying reality. India has 18% of the world's population, but only 4% of its water resources. And according to one water research organisation, water use is the significant blind spot in this whole equation. As we've discussed, the IEA expects AI to double data center electricity demand by 2030, now layer in water stress, and you've got a double bind. The situation presents a fascinating duality. On one side, you have this clear and present danger of water shortages. On the other, a recent survey shows a staggering 95% of investors plan to increase times their data center investments in the coming year. It suggests a potential resource bubble where asset valuations on paper are completely ignoring the physical risk of the taps running dry. Remember, we've argued this isn't a .com style mania. Today's AI build out is largely bankrolled by the profits of established giants. That profitability may be exactly why investors are underpricing these very real physical constraints. The numbers are staggering. Water consumption by these data centers is expected to more than double to 358 billion litres by 2030. That's a massive drain on cities like Mumbai and Chennai that are already facing acute water stress. So, what happens when the taps run dry? An expert from WRI India paints a chilling picture. Imagine shutdowns of data centers in peak summer. This could impact banking services, medical systems in hospitals using cloud services, and even transit operations. Still, the industry is racing to find solutions. We're seeing the emergence of zero water cooling technologies. Think of things like direct-to-chip liquid cooling or even immersion cooling, where servers are literally submerged in a specialized non-conductive fluid. Microsoft has already proven this can work, projecting savings of over 125 million litres of water annually per facility using new closed-loop designs. The catch: these technologies are expensive and require a level of infrastructure and expertise that might not be readily available, creating yet another massive challenge for India. We recently talked about Jensen Huang's virtuous cycle in AI. More usage begets more investment, which begets more capability. The question now is whether innovations like zero water cooling can bend that cycle so growth doesn't automatically mean more strain on scarce fresh water. The core conflict is clear. India is supercharging its digital future, but it's fueling it with a resource it simply doesn't have. It's a high-stakes gamble where, as one expert put it, you have to ensure that one good is not sacrificed for another in the middle of a widening global scramble to host the world's AI factories. We were just talking about the resource crisis hitting AI data centers in India. Well, that global scramble for resources has just opened up a new front, this time in Africa. A major global power balance just flipped. For the first time in over a decade, the United States has quietly overtaken China as the biggest foreign investor in Africa. The latest figures are a bombshell. In 2023, the US poured a massive $7.8 billion into the continent, dwarfing China's $4 billion investment. This isn't just about money. It's about a new high-stakes scramble for control. The prize? Critical minerals. We're talking about the lithium, cobalt, and rare earths that power everything you own, from your phone and electric car to AI data centers and advanced weapon systems. However, if you zoom out, you'll see another layer of strategy at play. This move to secure raw materials is the other half of a massive geopolitical puzzle. You've probably heard of the CHIPS Act, where the US is pouring billions into bringing semiconductor manufacturing back home. This is the same playbook, but for the very bottom of the tech supply chain. The thinking is, why build the factories if you can't get the raw ingredients? By securing these minerals, the US is trying to control the entire pipeline from the dirt in the ground all the way to the microchip in a fighter jet. For years, China has dominated this market, building a near monopoly on mining and processing, even rattling the US with threats to cut off exports. Now, the US is fighting back, and it's not being subtle about it. A key government agency, the US International Development Finance Corporation, or DFC, is leading the charge. Its official mission, stated directly on its website, is to act as a means of countering China's presence in strategic regions. But that's not the whole picture. The DFC is actually offering a fundamentally different deal than China's famous Belt and Road Initiative. Where China has been criticized for opaque loans that can lead to debt traps, the US is pushing a model based on transparency and high environmental and social standards. It's a direct challenge saying, we can be a better partner. They're not just throwing money around, they're strategically building alliances and offering an alternative path to development that aligns with US interests. This is a direct strategic challenge. American funding is now flowing to African mining companies to develop a supply chain that bypasses China and sends resources like tungsten and tin straight to processing plants in the United States. But the rabbit hole goes deeper. African nations are now caught in the middle of this economic tug of war. Experts are warning them to be assertive, to push for more than just cash for minerals deals, and to demand that refining and processing happen on their own soil to build their economies. But turning this opportunity into reality faces three massive hurdles for many African nations: energy, infrastructure, and expertise. Mineral processing is incredibly energy intensive. For instance, in a country like Zambia, the mining sector already consumes over half of the entire nation's electricity. Building new refineries would require a colossal increase in power that just isn't there yet. On top of that, you need massive investment in roads, railways, and ports just to make it economical. It's a classic chicken and egg problem. You need the industry to pay for the infrastructure, but you need the infrastructure to build the industry. This isn't just a shift in investment, it's the opening of a new front in the economic rivalry between the world's two biggest superpowers. The battle for the resources that will build the future is officially on, and the front line has been redrawn across Africa. Speaking of global rivalries, while the US and China are locked in a battle for resources, a powerful new tech axis is quietly forming between Japan and Europe. A staggering 33 billion euros. That's how much Japanese money has flooded into European tech startups since 2019. A massive shift that's quietly reshaping the global power map. To put that number in perspective, in the 5 years before, that figure was just 5.3 billion euros. This isn't a trend. It's a tidal wave of cash deliberately redirecting itself. And here's the twist. This money is bypassing Silicon Valley. After years of trying to partner with American startups, Japanese investors found the culture was a mismatch. They've now turned to Europe, favouring its more mature entrepreneurs, many of whom came from large corporations instead of university dorm rooms. Interestingly enough, this isn't the high-risk, fast-burn money that we often associate with venture capital. This is what you might call slow money. In the wake of the recent VC downturn, this patient, consensus-driven approach from traditional Japanese corporate investors is proving incredibly resilient, especially when you compare it to the high-profile, aggressive strategy of something like SoftBank's Vision Fund, which famously posted a $32 billion loss in a single year. These corporate investors are playing a completely different long-term game. The core conflict is that Europe has over 2 times more venture-backed startups than Japan, but has famously lacked the capital and industrial experience to scale them. Japan has both. This decision, however, brings both benefits and comes with inherent risks for Japan. While Japanese corporations are outsourcing their innovation by investing abroad, there's an ongoing debate about whether they are inadvertently hindering their own country's startup scene. The Japanese government has a startup development 5-year plan to boost its domestic ecosystem, but the country still lags far behind, with only a handful of unicorns compared to hundreds in the US. This is a strategic bet that accessing European innovation now is more valuable than trying to build it from scratch at home. One German CEO, whose company is backed by Japanese funds, put it bluntly, stating Japanese firms are, quote, just sitting on a pile of money, and now they're starting to spend it. She adds that their investment appetite is way stronger than any strategics I've seen here in Germany or in Europe. But this isn't just about cash. It's a strategic partnership. 70% of the deals are in deep tech and AI. Japanese industrial giants like Mitsubishi and Honda are bringing their robust manufacturing know-how, helping European startups build factories and scale globally, something Europe has struggled with for decades. What's unfolding is, believe it or not, the birth of a new global model. Think of it like this. Europe is becoming the world's deep tech research and development lab, and Japan is becoming the factory. The formal name for this is the IP, for industrial scale pipeline, where European intellectual property is combined with Japanese industrial might to mass produce the technologies of the future, from quantum computers to advanced materials. This alliance is funding the future. The UK's autonomous vehicle startup Wave raised over $1 billion with SoftBank's backing. A Spanish quantum computing firm secured a massive check with Toshiba's participation. What really brought this to a head was the next development. This isn't just a business story, it's a deliberate geopolitical strategy. Experts call this the creation of a third way in technology, a powerful bloc designed to be independent of both the United States and China. This has been formalized through things like the EU-Japan Digital Partnership Council, which is coordinating cooperation on everything from AI to semiconductors. This is a conscious effort by both Europe and Japan to achieve what they call strategic autonomy and build a resilient technological future on their own terms. From long-term strategic alliances, we now shift our focus to the volatile, day-to-day drama on Wall Street, where the AI trade is facing its first real test of nerves. The Nasdaq just had its worst week since April, with investors taking profits and AI-linked stocks taking a beating. But one of the biggest players on Wall Street, State Street, is telling everyone not to flinch. So the thing is, a lot of this volatility is driven by the very structure of how people invest in AI. We're seeing a massive influx of money into what are called thematic ETFs or exchange-traded funds that bundle AI stocks together. This creates a powerful feedback loop. As more money pours into the AI fund, the fund has to buy more of the underlying stocks, which pushes their prices even higher. It's a self-reinforcing cycle that can inflate valuations, and some experts are drawing parallels to the dot-com bubble of the late 90s. A while back, we analysed NVIDIA's Jensen Huang, calling this the virtuous cycle. On the technology side, better models bring more users, more profits. Then even better models and flows into AI-themed funds can amplify that dynamic on the market side. And as we noted then, this isn't a carbon copy of the late 90s. Enthusiasm is high, but valuations aren't at dot-com extremes. Despite the market flashing red, State Street's chief business officer, Anna Paglia, is doubling down on the AI trade. She went on the record with a direct challenge, asking, how would you not want to participate in the growth of AI technology? She believes the momentum is too powerful to bet against right now, stating a major rebalancing from growth to value isn't happening just yet. Now, get this bet on the growth of AI technology is largely a bet on future productivity gains that, for the most part, haven't fully materialized across the entire economy yet. This is what economists call a modern productivity paradox. We see AI everywhere, except in the broad economic statistics. While some AI-heavy industries are seeing huge productivity boosts, the overall economic impact is still emerging. So the market is pricing in a future that isn't quite here. We've talked before about AI shifting from a tool to a worker firm. Level wins tend to show up first, and the macro data often lags. And the numbers show the sheer scale of this tug of war. State Street's own SPDRNY SE Technology ETF is up a staggering 38% this year, but in the last week, it pulled back more than 4%. One of its key holdings, Palantir Technologies, got hammered, tumbling more than 11% after its earnings report. And this is important to grasp because it highlights the different bets being made within AI. Not all AI companies are the same. You have different layers in what's called the AI value stack. There are the hardware makers like NVIDIA, who control over 80% of the chips needed for AI training. Then you have the cloud providers like Amazon, providing the essential infrastructure. And finally, you have application specialists like Palantir, which builds software for specific government and commercial clients. The big question for investors is who will capture the most profit in the long run? The chip makers, the cloud giants, or the software specialists? It's not one single bet. Continuing our last discussion, Huang argued that we're in a $1 trillion replacement cycle for legacy compute, and rivals like AMD and Intel are racing out their own AI accelerators, another reason the profit pool may shift by layer and by cycle. However, a counter narrative is already emerging. We're seeing some investors taking a completely different path, seeing a quiet rotation gripping the market. The real story might not be a flight from tech, but a race to identify which non-tech sectors are about to become the next AI-driven growth engines. They see a renewed appetite for defensive sectors, with the Healthcare Select Sector SPDR fund, which was out of favour most of the year, suddenly starting to rally. This sets up the central conflict for investors. Do you ride the AI wave that, despite a brutal week, has delivered massive gains, or do you join the flight to safety in more defensive sectors like healthcare? And speaking of healthcare, research shows that sectors with heavy AI integration are seeing productivity grow at a rate of 4.3% compared to less than 1% in other sectors. In healthcare, AI is already being used for everything from dramatically speeding up drug discovery to improving diagnostic accuracy. So a flight to safety in healthcare might actually be a savvy bet on the next wave of AI-driven growth. A while back, we highlighted research showing AI-heavy industries posting nearly 5 times the productivity gains of others. Today's numbers give that a concrete flavour. But we also warned about AI pilot purgatory in sectors like commercial real estate, lots of pilots, few wins, which is why areas with cleaner data and clearer workflows like parts of healthcare may have the advantage. Even State Street's own expert admits a cooling off period is likely coming, but she doesn't see it until early 2025. For now, the market is caught in a high-stakes standoff between the incredible growth story of AI and the looming fear of a broader economic slowdown. And then there's the massive risk of geopolitics, which the market might not be fully pricing in. The entire AI trade assumes a stable, never-ending supply of advanced hardware. But what happens if that supply chain is disrupted? We're talking about specific choke points, like Taiwan's dominance in chip manufacturing or US export controls on advanced AI chips to China. We've already seen companies like Nvidia and AMD take billion-dollar revenue hits because of these policies. We previously warned about a budding compute oligopoly with TSMC and a handful of players as single points of failure. And remember, nations are now racing to build AI factories, Saudi Arabia included, which turns electricity into a strategic resource. The IEA expects data center power demand to roughly double by 2030. If power, talent, or chip supply get choked, that virtuous cycle can stall, and with it, the AI trade the market is banking on.
That's it for today on Voyage Daily Tech. Follow, share, and stay tuned for daily updates coming your way tomorrow.